Now, under growing pressures, the regulatory environment is changing. The UK government is currently consulting on the adoption of UK laws aimed at tackling money laundering and the financing of terrorism, stating that, and I quote, "The UK will not tolerate the use of crypto assets in illicit activity." This means that firms offering crypto asset exchange services will be required to fulfill customer due diligence obligations, assess the money laundering and terrorist financing risks, and report suspicious activity. Now, this session will focus and examine how the shocks that rang out from 2018 have impacted the response from regulators, address how the UK can implement effective frameworks to safeguard Britain as a leader in the space, and why cryptocurrencies remain a fundamental part of tomorrow's digital economy or not. So with that, let me introduce very briefly each of our speakers, and then they will introduce themselves in a little bit more detail. So to my far right is Mark Kelly, who's the UK Head of Compliance for Coinbase. Then we have Teana Baker-Taylor, who's the Executive Director and Board Member for Global Digital Finance. And finally, we have to my right is Dr. Abdalla Kablan, FinTech, AI, and Data Science expert. So with that, while I get seated, I'm going to ask Mark to take a moment and introduce himself a little bit more thoroughly. Mark, over to you.
Thanks. Good afternoon. So I have been head of compliance since January 2019 in Coinbase UK and CB Payments Limited, and more recently have become money laundering reporting officer. Prior to that, I was doing professional services in NextReg reporting, advising people how to do MiFID and EMIR regulatory regime reporting. So we'll see whether you can teach an old dog new tricks. Coinbase is known as, it has an aim of being the most trusted and easiest to use of the crypto platforms. We are represented in the UK by two entities, CB Payments Limited, which handles the fiat payments, the on-ramp into the crypto world, and is authorized by the FCA as an e-money issuer, and Coinbase UK, which is provides the crypto wallets and is the gateway to where everyone wants to be, which is the crypto universe.
Great, thank you, Mark. Teana.
I'm Teana Baker-Taylor. I am the Executive Director of Global Digital Finance, or GDF. GDF is an industry-led members body working on establishing standards, best practices, and a supranational code of conduct for the crypto and digital asset and blockchain community. We've been in existence for about a year and a half. We have just launched a registration self-attestment program, allowing our members, like Coinbase, as of today, to publicly attest their compliance with our code of conduct.
Great, thank you. Abdalla.
My name is Abdalla Kablan. I wear a number of hats. I'm a technologist based in Malta. I founded a number of companies specializing mainly but not exclusively in AI, machine learning, and their application in fintech. I'm also an academic. I lecture and research topics ranging from deep learning, algo trading, and principles of blockchain technology. In Malta, I'm also one of the directors of the Malta Stock Exchange, where I'm also the chairman of the blockchain committee at the Malta Stock Exchange. And since early last year, I've had the honor of acting as a senior external advisor for the Office of the Prime Minister of Malta to set out the regulatory framework, or to draft the regulatory framework for digital innovation and for technology arrangements and services, which culminated in Malta launching the world's first laws to regulate technology arrangements such as decentralized ledger technology, DLT, and blockchain technology.
Great, thank you very much. Let's get started. I've got a few questions for all of the panelists. So first off the bat, can we draw parallels between the crypto market crash of 2018 and the global financial crash of 10 years ago in terms of the public backlash, the loss of trust, and the subsequent regulatory response? Mark, you want to get us started?
Yeah, I think you could, but you'd find that the 2018 market crash or correction was minuscule in scale compared to what happened in 2008. I don't think it bears a direct comparison. In fact, the regulators and the Bank of England and the financial and the task force that looked into this, they definitely aren't cryptocurrencies' greatest advocates, but even they could not conclude that any systemic damage had been done to the financial system during 2018, despite the Bitcoin having retrenched 80% of its value.
So no systemic damage, but what about loss of trust, any potential public backlash? Teana, I know you've got some views on this as well.
So I wouldn't necessarily call it a crash.
Okay.
I would call it, a correction or natural price discovery following any type of bubble.
Okay.
There was definitely a bubble. And if we go back to the financial crisis of 2008, this is where the idea of Bitcoin and a decentralized payment mechanism was born.
Okay.
Out of that lack of trust created by the centralized monetary system that we have today. So in a nascent market, speculation is how something grows.
Okay.
Which did create a bubble and created some problems, but I think we're now in a period of natural process.
But do you not think we had a bubble in 2008, or do you think the circumstances were very different?
Personally, I think that the corporate malfeasance that led to the crash of 2008 was, as Mark says, at a staggering level compared to the very minor, nascent growing market cap of crypto in 2017.
Okay, and Abdalla, what do you think about this, and particularly with respect to the subsequent regulatory response? Do you see obviously much more happening now? Did you see a lot happening then? How do they compare between the two?
Yeah, I mean, even though both 2008 and 2018 exhibited similar behavioral traits, if you look at it from the outside, the circumstances, like Teana said, are completely different. And on the 2018 side, even though in my personal opinion is way smaller than the 2008 one, the reasons were different in the sense that the lack of regulation and also the regulatory pressure that came up all of a sudden in the wake of the ICO boom and the ICO, growth in 2017. So there was a huge confusion in the market in general. On one hand, the regulators have suddenly caught up that we have something that is growing, it's completely unregulated. The market was operating in a bit of a Wild West kind of setup where there was no regulation. The regulators started taking a very hardline approach of stopping and banning and impeding some of the projects from operating for very valid reasons. And hence the market started declining. But I see it as an adjustment that actually had to happen to kind of filter some of the noise that was happening in the market. Another fundamental difference is that the 2008 crash happened for pure financial reasons. And this time we have a technology-led initiative. So technology was at the forefront, which is what created the regulatory confusion, which is what put us under a lot of pressure, even Malta, to regulate the technology arrangement and service first before we look at the virtual financial assets that is underneath it, because no one understood the technology.
Okay. Do you agree with that, or do you disagree?
Yeah.
Tell us why.
I disagree. So whilst the technology is important and it does offer different ways to structure and bring financial products to the market, I'll use the same word again, the malfeasance that we saw around some of the ICO projects and the regulators becoming more heightened to what was going on is really about projects being presented for investment that didn't have either an underlying value, a sound business plan, a founding team that knew what they were doing. There are a number of elements that go into a successful project. Whether or not that project sits within a distributed ledger technology or is a new way to make a basketball. Okay. I don't think that the technology is the guiding factor for what led to the ICO.
I want to build on, you used the words heightened regulation. Let me lead on to the next question. Do you think heightened regulation is the answer to changing sentiments that cryptocurrencies are simply not secure enough? So we've seen it come. Do you think that is the answer? Mark, let's start with you.
Well, I think that regulation can alleviate a lot of fears. For example, if you took a stable coin, which according to the recent FCA consultation paper could be determined to be equivalent to e-money, every time you minted a stable coin, you would be obliged under the e-money rules to set aside the equivalent amount of money, and not just set it aside commingled with your own assets, but actually put it in a safeguarding account, a custodial account, where if your firm went belly up, the investor could actually retrieve the money. So there's a direct correlation between regulation and improved security in outcome for the investor.
Okay. Thoughts about that, Abdalla? Oh, sorry, Teana, you want to?
I think that if we, regulation isn't a blanket that sits over everything.
Yep.
So, sorry to jump on that technology bit, but I have a sensitivity around regulating the technology. I think it's difficult to regulate a technology. I have a sensitivity around regulating the asset itself. We don't regulate dollars or pounds, they're not regulated. The on-off ramps, the access to purchasing some of these products, anything that exchanges with fiat into the crypto space.
Yep.
So I think those market actors and those venues need guardrails to protect consumers, but I don't think we can regulate a technology or an asset in and of itself.
Okay, well actually that kind of builds on a question here from David Cortez. Why is it that in fintech forums all they talk with respect to blockchain and crypto is about regulation and not what we can do with a technology that requires no trusted third parties for issuance, transfer, settlement, and custody?
In fact, that's why I, again, completely disagree with Teana. We live in a completely different world. The world that we live in now is tech-driven. Technology comes at the forefront of everything. If you look not only at finance, you look at health. We have health tech, education, edutech, finance, fintech. In finance, for 2,000 years, since the very first financial product ever recorded, which was a grain contract in olden day in Sumeria, modern day in Iraq, until the 2008 crisis, innovation happened from within. But then the crisis hit, and as soon as the crisis hit, the financial industry had other things to worry about other than innovation. And all of a sudden, technology took over. We had tech giants that started coming up with different solutions to some traditional financial problems that we had out there. They started moving slowly into solving a lot of the financial problems that we have using technology. One of them is decentralized ledger technologies. When you have a trustless-based system using consensus mechanism to regulate certain activity that's happening, this completely reinvents the way that we've traditionally regulated certain activities, certain services. And that's why I know you have sensitivity when say regulating technology. I'm a technologist. I hate the word regulation. As soon as I hear the word regulation, I think we're stifling innovation. But the trick is striking the right balance between coming up with a regulatory framework that protects the consumer, protects the investor, and at the same time does not stifle the innovative process. However, technology is leading the way and it's reinventing the whole notion of the services that we're consuming, whether it's payments or the reinvention of value itself. So I think that, you know, technology, regulation is a very harsh word to use, but we have to be quite responsible and make sure that we have regulatory bodies that look at elements in technology such as scalability, such as security, such as adaptability, such as the ability of building decentralized applications on an architecture. At the moment, we're taking the word of the technologies that this is a great system, you can build on top of it. But there's no regulatory bodies that do this job, which is why, again, coming back to the approach that we used in Malta, we created a new authority that regulates the technology arrangement and service and vets it the same way the Financial Services Authority regulates the financial product. And unlike any other service that was regulated with the Malta Digital Innovation Authority, is a regulator of engineers by engineers. So even the teams that are a part of that regulatory process are engineers themselves. You cannot bring traditional regulators to try to regulate the technology.
But the technology is an infrastructure. It's a tool, right? So I appreciate that technology enables us to do things better, smarter, faster, cheaper than we were able to do it before. But ultimately, there are people building these pieces of technology. Even if you're looking at, artificial intelligence mechanisms, they're built by people, right? So if you're looking at ethics and conduct, and just because you can, should you, I think plays into the technology discussion a lot. And yes, is it possible for some of these smart contracts to be underwritten with mechanisms in place to prevent things from happening? Absolutely. But the challenge that we have today is a people challenge. It's an ethics challenge. When you have market manipulation, when you have trading venues that are not prohibited from wash trading or spoofing. So just because the technology is this, let's say it's pristine in it of itself, there are market actors that are interacting with that technology. And if you're talking about settlement finality, for example, it isn't quite as simple as it sounds.
Okay. Mark.
Yeah, I think it's quite important not to be blinded by this very interesting technology that underpins a lot of these innovations. But to look, when you are considering regulation, have a look at the economic substance of what's happening, because you can decompose and analyze any financial instrument by looking at the transfers of value and the conditions that attach to that value. And you might come to a different conclusion than if you just look at what are the characteristics of this coin or that coin. I think if you take a look at what's becoming a very hard and fast division into securities tokens, utility tokens, and exchange coins or sort of consensus coins, you probably want to differentiate further and start looking at, well, what actually happens within these contracts. Utility coins, even by the FCA, have been ruled by and large outside of the regulatory perimeter. But if you just look at the cash flows and you say, well, what I'm doing here with this coin is I'm locking in a future price of a service or a product like file storage or bandwidth, doesn't that start to look rather like a commodity forward? And don't we already have regulations pertaining to that? Now, if you say, well, it's a right, but not an obligation to obtain this service at that price, now it looks more like an option. And we've got the tools to handle this kind of financial instrument already there, and actually, potentially, should already be being applied to those topics.
Okay. I want a couple of more kind of bigger questions here. One, I want to pick up on ICOs, or initial coin offerings. Did they further undermine trust in crypto assets in 2018? And will STOs, or security token offerings, become the new model to deploy? So I'd like you to respond, but maybe if one of you, Teana, maybe if you can maybe explain the difference between ICOs, security token offering, and where do you see this going forward?
Okay, so very simple. A simple explanation. An initial coin offering is basically a mechanism for a capital raise. So I issue a token, you buy my token, and you are investing in whatever I plan to do, whether it's a platform or a service, etc. The issue with the ICO issuance that happened in the last couple of years was, unlike an IPO, where there is a number of steps that one must take, due diligence, legal contracts, there's a whole process around that. It could be expensive to raise that capital. That was largely missing from the ICO issuance. So if we're looking at an STO, a security token offering, those are different in that they're securities. So the same rules would apply for a token versus a non-tokenized security, essentially. So the big debate has been what's a security and what's not a security, and when does my project constitute a security? So what we're finding now is a number of these projects that listed ICOs, the initial coin offering, under the umbrella of it's a utility token, so outside the purview, it's not a security. Well, actually now maybe they might have been. Okay. So there's a little bit of reshuffling. So will STOs change the crypto landscape? Today, if you are going to invest in a security, certain levels of caveats apply to you. So you need to be an accredited investor or a sophisticated investor. So again, a different audience potentially than those people that were investing in ICOs because it was direct to consumer. So I do think that we will start to see a tokenization of securities, and we will start to see new people issuing security tokens. I don't know that it will necessarily replace and will be the only thing that we invest in.
Okay, Mark, thoughts on that?
Nothing really to add to what Teana said on that.
Okay, Abdalla, any thoughts on that?
No, pretty much. I mean, the landscape is now, consolidating with people and regulators are much more aware of the fundamental differences between a utility, a security, a financial instrument. And obviously, we've had, regulatory processes in place for many, many years when it comes to securities, like Teana said. So at least now we're drawing the distinction that when it comes to tokenization, and if you're exhibiting any form of security or you have any kind of security traits, you will actually follow the traditional route. Again, it's much more similar to an IPO. Maybe some people describe the STO as the blockchain version of an IPO. But again, an IPO is a much more rigorous process for reasons that we all know in the financial industry. It's been something that's been used for so many years. And now we're coming to grasp, in understanding the similarity between the STO and the IPO.
I think the correlation that's more interesting for context is if we go back to the late 90s when we have the big dot-com boom, that is very, very similar to what happened during this ICO period. So it is about raising capital to launch a business. And if we go back to that period, that burst as well.
Yes.
The major difference was we didn't have consumers investing in these projects. We had VCs basically spending their money. So there's a balance between fractional investment and wealth creation at a consumer level. So it shouldn't just be for the big guys. It shouldn't just be for the sophisticated investors. It should be a chance for everyone to join in that wealth creation.
Okay, so building on that point, kind of moving into the last theme I want to cover is looking at the role of government. Do they understand what you've just articulated about the consumer? And looking at the UK specifically, is the UK taking the right approach to regulating cryptocurrencies, or are there other countries, other models out there, other examples of how other parts of the world are potentially doing this differently? Abdalla, why don't we start with you? Maybe give us
I can't speak much of what's happening in the UK. I think you guys are much more authorities. But in Malta, we followed a very holistic approach. Like I mentioned earlier, we said, we have various elements here. We have the technology and we have the financial side of things, which is why we had to pass 3 laws in Malta. The first law last year, the first 2 laws, were more related to the technology side. We had a law to establish a new authority, the MDIA, the Malta Digital Innovation Authority. And the second law is to define technology arrangement and services, starting with DLT, out of which is a blockchain is an architecture. And we came up with the definitions of things that are quite technical when it comes to that: smart contracts, code injections, testing, and all that. But the third law, which is the one that's relevant here, is the VFA law, or the Virtual Financial Assets Law, which draws a clear distinction between the various types of tokens that could be issued. But not only there, also exchanges that operate in this space, brokerage firms that are operating in this space, investment companies, e-wallet providers. But again, we have to look at this as a holistic approach, because there will be elements where a token is identified as a utility. You do not have to fall under the Virtual Financial Assets Act, but then that's where the Financial Services Regulator will pass you still to Digital Innovation Authority to look at your tech stack, and vice versa. If your offering is related to iGaming or gambling, and you have people that are wagering bets on a gaming platform that is using cryptocurrency, that's where you have 3 regulators that should come into play. You have the Gaming Authority, the Malta Gaming Authority, the Malta Financial Services Authority, which looks at the token part of things, and third one is looking at your tech stack through the Malta Digital Innovation Authority. Maybe because our size is small, we're much more agile and nimble, but we found that this process is quite fast, seamless, especially that since there's a lot of interaction between the various regulators. In bigger countries, it might be a little bit different.
Thank you. Just want to get the other 2 speakers in before we wrap. Mark, to you, and then Teana.
Well, it's interesting that the big geographical and political entities really haven't pushed forward very well. The EU is kind of slow rolling this whole development of regulation. Even in the States, there's a patchwork quilt of different states have different laws around digital currencies. Pretty much the same has ended up happening where you wouldn't expect it to happen in the EU, where because things are going so slow, some countries like Malta, Gibraltar, Estonia, and Switzerland are kind of pushing ahead and jumping ahead of the rest. So that's all happening on the regulatory side. The one area where I would say there is a pretty good cohesive approach is on the anti-money laundering side.
Okay.
You know, the FATF rules for rolling out digital assets are going to be almost impossible to follow. There are various wrinkles to be unpicked and smoothed out in how that's implemented, but they are at least putting out a global idea of how cryptocurrency world gets folded into the anti-money laundering controls that are already applied to normal financial services.
Very good. And Teana, last word on this particular topic.
So from a UK perspective, I think that the Crypto Asset Task Force has done a very good job of bringing community into the discussion. So your question was, does the regulators understand what I just said? And I would say over the last 18 months, they have invested an enormous amount of time, energy, and resource to educate themselves. They are working actively with community through consultation. I've personally found them to be very open and collaborative. Now, our market in the UK is slightly different than the market in Malta. So do we need to enact a whole bunch of specific laws? You know, I don't know, I'm not a lawyer. I think there are existing laws that we could potentially retrofit. A really interesting study from the Cambridge Alternative Finance team came out last week that basically did a map of regulatory outlook on crypto assets and found that something like 78% of global regulators are looking at a retrofit approach as opposed to completely net new legislation.
Great. So an encouraging signal from the UK regulators from what you're seeing, yes?
I mean, things don't happen overnight, but I think we all need to keep in mind that the regulator's job is to protect consumers.
Yes. Very good. On that, we've run out of time, so I'd like to thank Mark, Teana, and Abdalla. Thank you for being such a great panel. Thank you, everyone. Thank you.